Thank you so much for joining us on the Dwelling Show. I'm your host, Ola Dantes. I've got the amazing and incredible Paul Moore with us today. Hey, Paul, how you doing?
Great, Ola. How you doing?
Doing fantastic. So glad to have you on the show. So, Paul, let's kind of just jump right into it. You've been doing this for quite some time. I can't wait to get some tidbits from you. So, just kind of start with who you are, what you've been doing, and kind of what you've been up to lately, actually.
Yeah, I did a multifamily uh, ground up development in North Dakota, and around 2011 owned and operated that for years with a partner, and decided I really love multifamily, but I didn't want to do ground up development anymore. So I joined a mentoring program, and I got involved, get to know really deeper dive into Class B and C multifamily. And I ended up writing a book called The Perfect Investment. And as a result of that time frame, I had told my wife, I promise I'm only going to do multifamily from now on. I'm not going to veer off of that into anything else. Well, I was also getting into my mid 50s, and Ola, I was starting to hate risk. I didn't want to do ground up development, but I also didn't, I felt like my acquisition team at my company was not doing a good job. That included me. We were not doing a good job finding off market apartments, and we couldn't find anything that wasn't overpriced. And so we thought, we're not going to overpay for these multifamilies. So we beat our head against the wall for about 4 years. And we finally branched out into self-storage and mobile home parks. And so we've been working in that arena for a couple years, and we're very excited about the opportunities there to acquire self-storage and self-storage and mobile home parks, I should say, from mom and pop operators, pay them a very good price, but have a lot of meat left on the bones for upside for our investors.
Yeah, that is really interesting. You said that actually. It's kind of like going full round in circle because I feel like I'm in that position right now. We were talking just before the call, before I hit record, and it's just making these deals work. It's just almost just it's just crazy right now. So I have been hearing a lot about mobile home parks, and I definitely want to touch on those a little bit. But I want to go to something that you said, which is ground up development. And dwelling, we're kind of in the process of vertically integrating our company, and development is one of those things. So I don't go down the same path that you did. Why didn't you like ground up?
So ground up development, or I should say developers, are some of the wealthiest people on the planet. But a lot of them are also delivering pizzas right now because it is so risky. And if you time it right, you can make millions. If you time it wrong, for sometimes, not always, sometimes reasons outside of your control, you can lose everything. Howard Marks, I think it was him, jokingly said that the wealthiest people in a real estate development deal are the third owners. Howard Marks wrote a great book called Mastering the Market Cycle, and he's basically Warren Buffett drops everything and reads everything Howard Marks puts out when he puts it out. So he's a smart guy. But he said the third owners of real estate are the wealthiest. He said the first, the developer, typically goes bankrupt. The second owner is the bank, and they typically sell it for break even or less after they get it back from the developer. And then the third owner is the one to make a big profit on it. And so I know that development is a great thing to do, but it's just not my skill set. And at my stage in risk tolerance, it's definitely not something that I want to do.
Yeah, fair enough. Yeah, that's really fascinating. So I'm guessing I have to ask. So I'm guessing the third guy, people like us, would the bank sell the asset to after they've foreclosed on the developer? So they sell it to apartment syndicators or apartment investors like ourselves. Is that who the third person is? I just want to
Yeah,
be sure.
yeah, you're the third guy, man. You're ready for success, Ola.
If I don't go into development, right?
Yeah, well, no, and again, I want to be clear, developers make billions of dollars, but it's just not for everybody. And the timing has to be right. Sometimes really successful developers lose everything because of timing outside their control.
Wow. Yeah, that's really interesting. That's what a way to start the podcast. Yeah, that's really interesting to learn. So, you did this ground up in North Dakota, and then you said you wrote a book. I'm just kind of curious to what made you, write a book. I'm just kind of curious.
Yeah, just be for self-centered motives, if nothing else. I realized, that I mean, I was in my early 50s, and I was found myself wishing that I had started apartment investing in my 20s. And so I thought, well, I'm 30 years behind here, so I got to make up some ground. I've got to start looking for investors. And I thought, well, I think one of the best ways to do that is to be an author. It'll give me a gateway to get on great podcasts like yours. And so I thought if I have a book, I'll be able to do a lot more promotion, publicity, etc. And as soon as I finished the book, I was able to jump right on Joe Fairless's podcast and others. And so it's been a great open door for me. And that's the real honest reason for why I wrote it.
Yeah, fair enough. Yeah, Joe's an amazing guy, obviously. Yeah, sure. So you guys, like you said, you were kind of banging your head on the proverbial wall, trying to get this multifamily deals to pencil out, and then you kind of shifted sideways. It's still multifamily, but into mobile home parks and then self storage. So can you just kind of tell us, kind of the differences apart from the fact that you made the numbers work? But what are the difference between kind of say mobile home parks and then apartments? And then why are mobile home parks not as sexy as apartments, right?
Yeah, they are becoming that. I mean, Green Street Advisors says that, and they're a big, advisory firm for the whole commercial real estate industry. They said mobile home parks are the darling of all commercial real estate now. They said that in April, but they haven't been. I think one of the reasons is the stigma with trailers. My mom always told me nothing ever good happens in a trailer park. Stay away from those places. And I think that stigma out there has just made it look like it's just not a very cool thing to be involved in. But, Sam Zell, the most successful real estate investor in America, probably on the planet, and Warren Buffett, both are deeply involved in the manufactured housing, industry and mobile home industry. Sam Zell has 158,000 mobile home park pads last I checked. And so it really is a significant, there are significant opportunities. When I first heard about value add in mobile home parks and in self-storage, I chuckled. I thought, what are you going to add value to in a mobile self-storage? I mean, think about apartments. They've got lights and color and flooring and cabinets and countertops, and you can add all these valuable things and raise the rent $100. That's true. But self-storage, what? It's got 4 sheets of metal, some rivets, a concrete floor, and a door. How are you going to add value to that? You sweep it out, you sweep the dust out for the next tenant. I had no idea that both these asset classes have tremendous value add opportunities. And at this point in time, with 93% of apartments above 50 units owned by corporations that have largely run the value out of them, there are a lot more upside in mobile home parks that have, 90% of the owners are, mom and pop owners that leave a lot of upside. And about 70% of the owners of self-storage are independent operators. A lot of those are mom and pops that have a lot of upside left in their deals.
So I just can't wait, Paul. Like I am where you were when you were saying how in the world can you add value to a storage space and a mobile home park. So if you don't mind, just kind of, I don't want to kind of just
Yeah.
guess. Like, can you just kind of go through a few for each asset
Yeah,
class?
let me buzz through a few. So of course, but I want to make sure the listeners know that, residential real estate the value is based on comps, comparable properties in the neighborhood. But commercial real estate is based on an equation. It's based on math. And that equation is the value is the net operating income divided by the rate of return, or the cap rate. And so if you can move the net operating income up And if you can sometimes shrink the cap rate, you can mathematically increase the, excuse me, the appraised value of that asset. And so let's take self-storage. You can add a showroom and you can sell locks, boxes, tape, and scissors. And you can also sell renter's insurance. You can also charge admin fees and late fees. These are things that typical mom and pops don't do. They can also, a mom and pop seller often has a lot of land. For example, a self-storage facility I'm looking at right now in Florida has like 150 units, but it has 10 acres of vacant land with it that they're doing absolutely nothing with. So there's a lot of things that can be done. Another big value add for self-storage is adding a U-Haul. Let's do the math on that. So you can add, I'm thinking of a self-storage facility in Florida that gets over $5,000 a month in commission from U-Hauls. The typical range is $2,000 to $5,000 a month. Let's say you can add $4,000 a month. All right, let's say you paid $3 million for your self-storage facility. That's $1.5 million cash and $1.5 million debt for our example, okay? Now, let's say you can add $4,000 a month in U-Haul commissions, okay? So that's $48,000 a year you're adding to your net operating income. And that's with no additional capital expenses, at least none to speak of. And you divide that, again, our value formula, right? Net operating income divided by cap rate. Divide that by 6% cap rate, that's 0.06. 48,000 divided by 6%. Look at that, 800,000 increase in value.
Yep.
So the 1.5 million in equity out of that $3 million deal just increased by $800,000. That is a huge increase in equity the bankers don't share. So that's self-storage. Mobile home parks, here's some value adds. A lot of mom and pop sellers still, they might charge 20, 30% below market rents. So just, incrementally inching the rents up over a few years to market levels is one value add. Second, over the years, typically a mom and pop owner seller will have a lot of vacant lots. So I'm thinking of a 311 lot mobile home park in Louisville, Kentucky that our operating partner acquired. It had 50 vacant lots, okay? Well, the seller hadn't even been to the park in 5 years. And these vacant lots would not get filled. And so the value adds for him are, number one, everybody else in the area was passing back water and sewer, and of course electric, to the tenants to pay themselves. Well, this company, this owner, this mom and pop was eating those expenses. That was like $200,000 a year. Well, passing that back to the tenants, this was a $7 million more or less acquisition. Well, $200,000 a year passed back to tenants at 6% adds $3 million to the value of that $7 million asset.
Crazy.
Second, lot rents in the 260 lots that were there were $100 below market. So let's say they just increased them by $25 the first year. $25 times 260 lots is 78,000 in increased lot rent, and it's still way below market. Divide that by 6% cap rate, there's a $1.3 million increase in value to the property. The third one is a little harder, and like I said earlier, filling vacant lots. By aggressively bringing in used and some new mobile homes to the park and then selling them, even at a break even to the occupants, to people who will come in and live there, you're dramatically increasing the value of the park. Let's just say in a typical park, anywhere from $70,000 to $110,000 in value created using our formula for every lot filled. You can also rent carports, decks, sheds, things like that to the tenants at a very low cost. That would be a real blessing to them, but would really add to the bottom line. So there's lots of value adds in these asset classes. You can see I'm a little excited about it.
I can tell. Yeah, no, and you've got me excited too, actually. Yeah, because we have been thinking about, MHPs for quite some time, but I'm just really careful as to introducing a new asset class to our investors, because I might make them feel, hey, this is a
Right.
little bit different, right?
I got to tell you something. So I mean, look, I humbly entitled my book, that's a joke if you're listening, The Perfect Investment. And I was sure that my investors would have a rebellion if I added mobile home parks or self-storage, but I was completely wrong. I've never had one investor that I'm aware of who turned against us because we added an asset class.
That's good to know. Yeah, no, that's definitely good to know. So I really love what you mentioned about the value add, especially for the mobile home parks or RUBS, right? So ratio utility billing system, billing back the,
Right.
the residents what they use, the lot rate increases, bringing in new or used mobile home parks to sell, and then rent carports and decks. So those are pretty awesome one. I think maybe we can do like a case study of a mobile home park that you bought. Just kind of tell us, how did you guys find the deal, how did you fund the deal, and how's the asset doing now if you haven't disposed of it.
Well, let me, give you, let me tell you quickly about our model. We decided when we got into this asset class that we did not want to be the operator. We did not want to be the one to go out and acquire these assets. We wanted to be a due diligence company. So Wellings Capital is a due diligence company that goes out and finds the very best in class, most experienced operators, and we invest heavily with them. But let's go over a quick example here. So one of our operating partners has a team of 4 people that call investors 8 hours a day, 5 days a week. I mean, they call mom and pop owners, I should say. And so they were on the phone with this mom and pop group out of a small town in Beeville, Texas. And it was a self-storage facility. The parents had unfortunately passed away, and all 5 kids were fighting about how to run this facility, while of course it was all just going downhill all the time. And so they looked at the numbers, and my friend, the operating partner, offered, I think it was $2.3 million on it. And they may have offered a little less, is what I'm saying, but they did close on the property at 2.3 million. And he found out during the closing process that it was actually on the market with a broker for $5 million. And he bought it for 2.3. Now, 2.3 was a fair price given the fact that it had huge delinquencies. Rents were 26% below market value, market rates. The occupancy had trended down and down and down. I think there was no website, no U-Haul, no all kinds of things that they could have done they weren't doing. And so it was a fair price at 2.3 million. Well, my operating partner got in there. He added U-Haul. He brought delinquencies from like some enormous number down to like 5%. He increased occupancy over just 3 or 4 months with some good marketing up to a normal level of about 94, maybe 92%. And he raised rates by, I believe it was close to the 26% that they were behind. And the appraised value, he bought it in March of 2019. We invested in it right after that. And we invested heavily in this property. I'm glad we did, because on June 28th, 2019, believe it or not, just 3.5 months later, this property was appraised. Remember, he bought it for 2.3 million. It was appraised for $4.6 million. If you assume that he took on 50% debt and 50% equity, his equity in that original property, let's just say it was $1.7 million. It was just increased by 2.3 million more, bringing the equity from 1.7 million to about 4 million that quickly. I think I might have done the math wrong. Maybe it was, yeah, it's about right. I think the equity was way more than doubled that quickly. Honestly, investors that we talk to can't even really believe these stories, but I'm telling you, I've seen him do this over and over and over.
Wow. Yeah. This is really fascinating. You definitely got my attention. That's for sure. Yeah. So tell us, a little bit more. Just I know you mentioned, some more about the book, but just tell us a little bit more about the book. Where can we get it? What was the story about? How can folks find it?
Yeah, so the book is called The Perfect Investment, and it's basically my theory that multifamily investing has the perfect balance of risk, return, demographic foresight. We're able to look down the road at the demographics decades ahead, not with certainty, but I mean, we can see based on birth rates what the demand will be in 25 or 30 years for apartments and all kinds of things. And so it's I just think it's a great asset class when it's not overpriced and when it's available. Right now it's really hard to find good deals in apartments. But the book goes over a kind of a high level how to get involved in this asset class. It's arguing for getting involved at a high level with large apartments, not small ones at first, and basically going over how to become a syndicator, etc. All the stuff we love. I've got another book coming out called Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage. And that's being published by Bigger Pockets Publishing in late 2020.
Awesome. Well, I'm definitely looking forward to that, Paul. When that comes out, I definitely want to buy that. Yeah, I mean, we're definitely dividing into the quick rounds. These are going to be quick questions, quick answers. You ready, sir?
You bet.
First question. What makes you, Paul, unique? What is that differentiating factor that separates you from the next guy or the next girl?
Yeah, so one thing that makes me unique, I think, is I made a couple $1,000,000 when I was only 33, and I realized there was no great joy in that. There was definitely no great joy in the semi-retirement. And so here I am in my mid-50s, knowing that I never plan nor desire to retire. And I found myself with a need to have a big why as a result of that experience. And so that's one thing I'd say.
Yeah, nice. Second question. What was the last book that you read, and what was the one thing you picked up from that book?
It was called Never Split the Difference by Chris Voss. And I'm on my second read through right now. And what I picked up was that I need to be a much better listener.
Yeah, that's one of my favorite books of all time, actually. Yeah. Last question. Of course, you're investing a ton. You're obviously writing books with Bigger Pockets. You've got your hands full. I'm sure you're spending time with the family. What do you do for fun? Or maybe that was the answer.
Yeah, I had this question on the Bigger Pockets podcast and I stumbled over it. I was like, yeah, I like to windsurf. When was the last time you windsurfed, Paul? Oh, well, like 7 years ago. But no, seriously, I love spending time with my family. I have one daughter who loves movies. We watch movies. Another daughter who likes to go for drives and go get ice cream. My son loves to go fishing and hunting. And so we do that together. That's what I love to do. And of course, my wife of 33 years, her and I have all kinds of things we share, including movies, good dinners, things like that. Kind of boring though.
No, I love it. I mean, I love it. I mean, I can totally relate with all of those. Yeah, actually. So yeah, I mean, really appreciate you coming on the show. If there's somebody listening and thinking, wow, Paul has got me really interested in learning more about, MHPs or self-storage, what's the best way folks can reach out to you, get connected with you, know more about you?
Yeah, thanks for asking. I'm all over Bigger Pockets a lot, but you can reach out to me at wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com.
Paul, an absolute pleasure. You're a legend. Thank you so much for coming on the show. I really appreciate your time. Thank you so much.
Thanks, Sol. It was really an honor to be here. Thank you so much.